Harish Krishnan is also joining us. He's Executive Vice President and Senior Fund Manager, Equities at Kotak Asset Management Company. Harish, it's always a pleasure having you with us here on the program. Thank you very much. I just want to start with a broader question to you, Harish, on the markets themselves. What are the sort of top 2 or 3 big kind of dominating drivers for markets from here out, Harish? And I know you look at valuations very, very closely, and I think you were a little uncomfortable about how valuations, especially in some sectors like consumers, etc., were. So tell us, what's your view now?
So Prashant, clearly the view is that the last 15 odd months has been only about macro. So view number 1, I think, is that macro is going to matter less and less, or an edge related to macro is going to matter less and less. And it's going to be more about micro. And there clearly there are some opportunities of some companies, weathering the storm much better than the other. From a big picture point of view, the view number 2 or the bigger trend that we see is clearly that material costs are starting to come off. We saw in the September quarter one of the lowest margins, both on gross margins and EBITDA margins for the broader market. And clearly, it was led by inventory losses due to the volatility in commodity, and also the fact that commodity prices had gone up. The WPI was significantly higher than CPI. We have now seen a convergence of WPI and CPI in India, which means that going forward, we do think that margins will be the bigger driver going ahead, rather than just top-line led growth happening in India. View number 3, I think that the rate of change globally is improving much faster than in India. And therefore, we do think that, it did seem that maybe about 6 months back, that it was all doomsday scenarios being painted across the world, be it in Europe, be it in China or in US, where there, most people were predicting a short recession. It does look like things are improved quite dramatically in all of these 3 areas. And therefore, the rate of change incrementally is looking much better globally than in India. So I think these would be the 3 broad views in which we shape our portfolios. Coming to your query on valuations, we do think that there has been some moderation in valuations. It still is, I wouldn't say it's nosebleed at most places, but it still is, fair value plus in aggregate. There are some pockets which have opened up in terms of a slight reduction or slight moderation valuation, and that is what we would want to use to kind of allocate at this point of time from a portfolio point of view.
Harish, hi, good afternoon. Surabhi here. Good to be chatting with you. So, in light of what you just said, sort of slice it up for us in terms of sectors where you see that comfort. For instance, IT could be one such sector, but then do you also see commensurate growth coming in over the next couple of quarters? Are you looking for value plays then?
Right. Given that I said that the rate of change globally is on the betterment, clearly IT is something which we have at least cut our underweights. We've gone neutral. Clearly, valuations are still not very comforting, given the fact that generally, they tend to be significantly below from a trough point of view. So in that context, we have cut our underweights. We are neutral now. But we do see opportunities in, for example, energy using sectors, so for example, gas utilities, or it could be the cement pack, home building materials. Over there, we have a lot more comfort on both in terms of valuations, as well as the fact that, the gross margin compression that we've seen for a lot of them is behind us, and we are likely to see some kind of operating leverage. The third aspect is clearly in terms of auto and auto ancillaries, and to a certain extent on the industrial side. Over there, we do still get a sense that, consumption is still in the back foot, and infra manufacturing is still, I would say, reasonably in much better shape. And so these are the 3-4 key areas where, we are deploying incremental capital in as far as our portfolios are concerned.
Got that. I remember last time, Harish, you were a bit worried about the banking sector. This was when we had spoken about a month back. Now, the banking numbers have been rock solid across the board, PSUs and private. Do you continue to maintain your anxious stance on banking? And if yes, why?
So even at that time, we did allude to the fact that it was a Goldilocks moment for banking, with all the three vectors, in the best of shape, be it credit growth, be it pre-provision operating profits, or in terms of NIMs. And I think the worry clearly is that at the rate of change from here would be, at least one or two of these dimensions could slip up. Again, we are not saying that it's going to go back to the worrying trends that we saw pre-COVID. No way. I think it's too early for us to be negative on that count. But from a point wherein banks did all the heavy lifting in terms of earnings, they had a superb, stellar set of numbers and prints. We think possibly another quarter could be where those prints can sustain, and beyond that, it'll start, kind of moderating a bit. Having said that, bank stocks or financials have corrected, not necessarily because of the earnings, but because of the other reasons, in terms of exposures, etc. And therefore, it does provide us an opportunity to cut back some of that underweight stance that we have in certain pockets of financials, and that's what we are currently doing.
Okay, so you expect some chinks in the armor to show up perhaps in Q1 FY24. Next quarter could still look good for banks. Thank you very much, Harish, for joining in. Need to slip into a very short break. As we do that, we'll get you a check on what dealing rooms are saying in our segment D Street Chatter. We'll also tell you what you can buy today to sell tomorrow. Calls from our technical experts.